All right, welcome back everyone. If you're seriously aiming for that A star in IGCSE Accounting 0452, well, you've landed in exactly the right spot. Today, we're jumping straight into a high-energy masterclass explainer, all about capital and revenue expenditure. Now I know, expenditure sounds like everyday, run-of-the-mill bookkeeping. But look, I need you to shift your mindset right now. This module, it isn't just some basic record-keeping exercise. It's literally the bridge between basic data entry and high-level financial intelligence. Master this, and you're proving to the examiners that you deeply understand the actual architecture of a business's finances. Let's get into it.
And let's kick things off with a massive, critical update. You know, the language of accounting is always evolving, and honestly, so must you. For the syllabus 2028-2030 updates, Cambridge has fully transitioned to modern international terminology. So what's the bottom line for you? Absolute zero tolerance for outdated terms. None. You've got to use irrecoverable debts instead of bad debts. You have to use owner's equity instead of capital. And I mean with 100% accuracy. Look, dropping the ball on these terms just screams, I don't know the current syllabus, and as an examiner, I am absolutely not going to let you make that mistake.
Right, so here's our quick roadmap for this explainer. 1, we'll hit core architectural concepts. 2, the technical execution strategy. 3, we'll dive into AO3 ratios and evaluation. 4, a real-world fintech application. And finally, 5, we're spilling the examiner's secrets and pitfalls. Okay, let's jump right into part 1. Core architectural concepts, building the foundation.
So, the basic difference between capital and revenue expenditure, it looks so visually simple, right? But man, is it ever easy to mix up when that exam clock is ticking. On one side, you have capital expenditure. Think of this as your long-term investment. You're buying non-current assets, or you're adding real, lasting value to them. Then, on the flip side, revenue expenditure. This is your day-to-day running costs, the maintenance, literally the operational lifeblood that keeps the doors open. Now, you absolutely must understand the duality of every single transaction here. The business entity concept is always at play. Whether it's a capital or a revenue item, you are constantly balancing that golden accounting equation. Assets equal liabilities plus equity. If you mix these two up, you don't just lose a quick mark. You entirely distort the final financial statements. It's a huge deal.
Exactly. And that brings us right to the prudence concept. Look, accounting isn't just robotically recording what happened. It's about being cautious. It's about being realistic. The prudence concept essentially dictates that profits and assets are never, ever overstated, and you absolutely cannot ignore potential losses. When you get to those complex scenarios in paper 2, they're going to throw specific vocabulary at you. Words like accrued, prepaid, realization, and consistency. Think about it. If you accidentally misclassify a revenue expense as a capital expense, what just happened? You've hidden an expense. You've artificially pumped up your profit and overstated your assets. That is a direct, flagrant violation of the prudence concept. And let me tell you, it will instantly derail a perfectly good exam paper. Banks, owners, regulators, they all demand total transparency.
Moving on to part 2. Technical execution strategy, earning method marks.
Subject specialist. Getting the technical execution right here requires a super methodical approach. Think of it like a chain where every single link has to be stress tested. Step 1, identify your source document. Are we looking at an invoice, a credit note, maybe a bank statement? Step 2, use that exact document to update the correct book of prime entry. Step 3, post that straight to the ledger and balance out your T accounts. And finally, Step 4, finalize that trial balance to double-check your arithmetical accuracy. If you follow this precise procedural logic, you guarantee that you're tracking the transaction flawlessly, from its very first origin all the way to the final financial statements. Now lean in, because here is the ultimate A-star secret. We're talking about the classic T account, the absolute gold standard of the double-entry system. You have to master the art of balancing these accounts by clearly and boldly distinguishing your balance brought down, your B/D, from your balance carried down, your C/D. Why is this so crucial? Because we examiners generously award method marks, even if your final mathematical balance is slightly off. Seriously, no joke. If you make a tiny arithmetic slip-up, but the examiner can clearly see your logical flow, your workings, and that you correctly used B/D and C/D, boom, method marks awarded. So never, ever leave a T account blank just because you're second-guessing the final number. Always show your process. Next up, part 3. AO3, Ratios and Evaluation, Interpreting the Data.
Listen, calculation is just a baseline skill. Honestly, a computer can calculate. An A-star student, they evaluate. I want you to ask yourself,
Why did a current ratio fall drastically from 2.5 to 1 all the way down to 1.1 to 1? This right here is Assessment Objective 3 in action. I need you looking way beyond the baseline numbers and actively debating the cause and effect chain. A massive sudden drop in liquidity like that doesn't just magically happen out of nowhere. Something structural inside the business shifted, and guess what? It is your job to investigate exactly what that was.
Let's actually break down the mechanics of a drop like that. Falling to 1.1 to 1 means the business is teetering dangerously close to not being able to cover its short-term debts. But why? Well, maybe inventory was massively overpurchased, and it's just sitting there gathering dust in a warehouse, tying up all their cash. Or maybe trade payables are being settled way too slowly, which absolutely wrecks supplier relationships. Or, and here is the direct link back to today's module, maybe cash reserves were totally depleted by heavy, poorly planned capital expenditure. Buying a brand new factory with cash? Yeah, that will absolutely tank your current ratio. See, this is exactly how you connect specific management actions to real-world financial outcomes.
And when you're tackling inter-firm comparisons, examiners are desperate to see you analyze the underlying quality of a profit. You simply can't compare two businesses side by side if they're using totally different accounting policies. For instance, one might use the straight-line method for depreciation, which spreads costs evenly, but the other uses the reducing balance method, front-loading that expense. That alone instantly skews their reported profits. And beyond just the numbers, true A-star evaluation means discussing non-financial factors too. What's staff morale like? Are they in a prime, high-traffic location? Do they have a stellar reputation in the market? Ledger accounts don't capture these things, but they are absolutely vital for a company's long-term sustainability and their return on capital employed.
All right, let's look at part 4. FinTech, real-world application beyond the classroom.
To hit that syllabus research directive and give you a real competitive edge, let's look at a 2025 FinTech case study. Look at AI-driven accounting software today, like Xero. It handles massive, overwhelming volumes of data and actually automatically learns to distinguish capital from revenue expenditure, just based on context and historical tagging. So this isn't just some classroom theory you're cramming. It is literally the algorithmic bedrock that the entire global fintech industry relies on. The duality concepts you are mastering on paper right now, they're the exact same rules governing multi-million-dollar AI systems. Understanding the why behind how the software classifies things, that's what elevates you from a data entry clerk to a true financial analyst.
And finally, part 5. Examiner secrets and pitfalls, the playbook.
Okay, straight from the grading floor, here is the playbook. These are strict warnings about common, easily avoidable pitfalls that absolutely devastate exam grades. Number 1, poor handwriting in ledger accounts. Seriously, if I cannot read your numbers or distinguish your B/D from your C/D labels, I simply cannot award you method marks. It really is that simple. Write clearly. Number 2, failing to strictly distinguish revenue from capital, which we've harped on today. Number 3, mathematical pitfalls, specifically messing up the percentages in trade discounts versus cash discounts. Do not forget, trade discount is always applied first, right on the catalog price. And lastly, a huge red flag for me, missing state symbols in manufacturing accounts. Pay attention to those fine details, guys. They literally are the difference between a B and an A star.
Look, under exam pressure, that clock is relentlessly ticking down, and it's totally normal for your mind to sometimes go blank. You need a dedicated memory hack to lock down the core accounting equation. So here's a super simple one to keep you grounded. Accountants love equity. ALE. Assets equal liabilities plus equity. Accountants love equity. Whenever you are sitting there adjusting a capital or revenue expenditure, just quickly write down A equals L plus E right there in the margin. Check your duality. Did your asset increase? Okay, well then either your cash liability decreased or your equity changed. Just keep that little formula anchored in your mind and you will stay perfectly balanced every time.
And that brings our explainer to a close. But before you go, I want to leave you with one final provocative thought, a true A-star challenge. I want you to pause and really think about this. How does a misclassified capital expenditure artificially inflate ROCE, return on capital employed, all the way out in year 3? Think about the chain reaction there. Think about the mechanics of depreciation over time. Think about the accumulated effect on the balance sheet and the profit for the year. If you can untangle that multi-step problem, you will have permanently cemented your mastery of this entire topic. Thank you so much for joining us for this explainer. Keep practicing, keep your logical flow crystal clear, and go get that A-star.